In this video, we are going to explore 3 effective strategies for using the moving average indicator to produce highly accurate trading signals. If you are truly committed to becoming a professional trader, you should certainly look into our complimentary training program via the links provided in the description. Now, let's begin today's lesson. What exactly is a moving average? It is a fundamental technical tool that computes the mean closing price of an asset throughout a specific time frame. To illustrate, a 1-0 period moving average identifies the average closing price of the previous 10 candles. This indicator helps traders filter out market noise and visualize the trend more clearly. Various moving averages cater to different types of trends. For instance, a 2-0-0 period average is ideal for spotting long-term market directions, while a 2-0 period average is best for determining short-term price movements. Settings like 20, 50, 100, and 200 are the most common periods for moving averages. In general, these indicators help traders spot the market trend and make price movements easier to understand. Now, let's take a closer look at the specific functions of a moving average that can improve your trading. Primarily, this tool serves 3 main purposes. 1. Identifying the current trend. 2. Spotting a change in trend. And 3. Locating dynamic areas of support and resistance. We will begin with trend identification. Since the moving average is a trend-following indicator, its main job is to help you see the overall direction of the price. There are 3 main methods to achieve this, starting with comparing the price position against the moving average. By looking at where the price sits relative to the moving average, you can define the trend. If the price remains consistently above the average line, the market is in an uptrend. As smart traders, we aim to follow the trend's momentum. Therefore, in an uptrend, we should focus primarily on finding buying opportunities. Conversely, if the price stays below the moving average for a while, it signals a downtrend. In this situation, it is better to look for selling setups. Finally, in sideways or range-bound markets, price won't remain above or below the moving average for long. Instead, it frequently fluctuates above and below the MA like a swinging pendulum. In these situations, it is often wisest to avoid trading and wait until a definite trend starts to emerge. A helpful tip for improving your analysis is to apply 2 moving averages with different settings. This allows you to observe both the short-term and long-term price behavior simultaneously. For instance, look at this chart featuring 2 moving averages, a yellow 2-0 period MA and a blue 2-0-0 period MA. The 20 MA acts as a short-term indicator, reflecting fast market trends. Meanwhile, the 200 MA is a long-term indicator that reveals the broader market direction. Let's temporarily disregard the 200 MA. Focusing solely on the 20 MA, we can see price was above the line during these times, signaling an uptrend and suggesting buy entries. Likewise, when price stayed below the moving average, it signaled a downtrend for short-term selling. However, a closer look shows these downward moves lack strong momentum. When we reapply the 200 MA, we can see that the price remained above it the entire time. This confirms that the market was in a sustained, long-term uptrend. Armed with this insight, we can conclude that taking sell positions would have been dangerous, as it meant betting against the dominant long-term trend. Let's look at another example. Zooming into this chart section shows the price fluctuating closely around the 20 MA for quite a while. This indicates a short-term sideways market. However, notice that the price consistently held its position above the 200 MA at the same time. This shows the long-term trend is still up, creating a sideways consolidation with a clear bullish upward bias. In this situation, you could either stay out of the market due to the lack of direction or look for buying opportunities near the bottom of the range. However, you should avoid selling at the top of the range, as that would mean trading against the powerful long-term upward trend. Using a dual MA setup doesn't necessarily guarantee perfect entries, but it is an excellent way to filter out high-risk or low-probability trades. If you find this information helpful, please hit the like button and subscribe to our channel to stay updated with our latest trading content. The slope of the moving average is another great way to gauge trend strength. By observing the angle of the line, you can understand how powerful the current trend is. During an uptrend, the MA lines point upward. A steep angle, often near 45 degrees, signifies a very strong uptrend, whereas a shallow or gentle incline indicates the trend is gaining strength slowly. This logic is identical for downtrends. A sharp 4-5 degree downward angle shows a powerful move lower, while a slight downward tilt suggests a much weaker bearish trend. This insight is vital for strategy. You can be more bold with entries when the trend is clearly strong, but you should practice caution if the slope looks weak or flat. Comparing long-term and short-term moving averages is another reliable trend identification method. Simply look at where the two lines are positioned relative to each other. For instance, let's look at a chart with the 50 MA and 200 MA. Here, the 50 MA is the fast or smaller line, while the 200 MA is the slow or larger line. Whenever the shorter-term 50 MA sits above the longer-term 200 MA, it is a clear technical signal that the market is currently in a healthy uptrend. During an uptrend, focus on finding buying entries. Conversely, when the shorter-term MA stays below the longer-term MA, the market is in a downtrend. As disciplined traders, you should prioritize looking for selling opportunities during these periods. Those are the three primary methods for identifying trends with moving averages. Next, we will explore how to utilize the same indicator to spot potential market reversals. We use two main techniques to spot trend reversals. The first is the price crossover. Recall our discussion that price usually stays above the MA in an uptrend and stays below it during a downtrend. Following this same logic, when the price breaks below the moving average from above, it suggests the uptrend has ended and a bearish move is starting. This signals a downward reversal in price. Similarly, if the price crosses above the moving average from below, it indicates that the downtrend has likely finished and a new upward trend is about to begin. Keep in mind that not every price crossover is a valid trade signal. Many can be fake-outs. To avoid these traps, we can use a moving average crossover strategy instead. One of the most popular techniques for identifying trend reversals is the moving average crossover. This method has been used by traders for many years because it is simple to understand and easy to apply. To use it, all you need to do is place two moving averages with different period settings on your chart. Typically, one moving average represents the short-term trend, while the other represents the long-term trend. By observing how these two lines interact with each other, you can gain valuable insights into potential changes in market direction. Just as in the previous example, we'll use the 5-0 period moving average together with the 2-0-0 period moving average. These are two of the most widely recognized moving averages in technical analysis because they provide a balanced view of both medium-term and long-term market trends. As we discussed earlier, when the market is trending upward, the shorter-term 50 MA normally stays above the longer-term 200 MA, reflecting stronger buying pressure and continued bullish momentum. Likewise, during a downtrend, the opposite relationship occurs. The shorter-term moving average remains below the longer-term moving average because selling pressure dominates the market. Based on this principle, if the 50 MA crosses below the 200 MA, it indicates that bullish momentum is weakening and that sellers may be taking control. This crossover suggests the market could be transitioning from an uptrend into a downtrend, making it an important signal to monitor. This type of crossover is commonly interpreted as a bearish reversal signal because it reflects a shift in overall market momentum. On the other hand, When the shorter-term moving average crosses back above the longer-term moving average, it suggests that buying pressure is increasing once again. In other words, the market may be transitioning from a bearish environment into a bullish one, providing traders with an early indication that a new uptrend could be developing. For this reason, traders often view this crossover as a bullish reversal signal. However, it's important to remember that no indicator is perfect. Moving average crossovers can sometimes produce false signals, especially in sideways or highly volatile markets. Instead of relying on crossovers alone, it is much more effective to combine them with other forms of technical analysis, such as support and resistance, candlestick patterns, trend lines, or momentum indicators. Doing so can greatly improve the quality of your trading decisions and reduce unnecessary risks. So far, we've covered the two primary methods for identifying trend reversals using moving averages. However, that's not the only reason why this indicator is so valuable. Another one of its most important applications is identifying dynamic support and resistance levels. Unlike traditional horizontal support and resistance, these levels move together with the trend, giving traders a more adaptive way to identify potential areas where price may pause, bounce, or reverse. Let's take a closer look at how this works in practice. Traditional support and resistance are fixed horizontal price levels that are drawn based on previous highs and lows. While these levels remain in the same position, the market is constantly moving and evolving. This is where moving averages offer a unique advantage. Instead of remaining fixed, they create dynamic support and resistance levels that move together with the price. As the trend develops, these levels continuously adjust to current market conditions, providing traders with a more flexible way to identify potential reaction zones. During a bullish trend, the price generally remains above the moving average, showing that buyers are still in control of the market. As temporary pullbacks occur, the price often retraces toward the moving average before resuming its upward movement. In many cases, the moving average acts as dynamic support, causing the price to bounce higher once it makes contact. These pullbacks can provide traders with favorable buying opportunities because they allow entries in the direction of the prevailing trend rather than chasing price after it has already moved higher. As shown in this chart, the moving average successfully acted as a support level on 3 different occasions. Each time the price retraced toward the indicator, buyers stepped in and pushed the market higher once again. This repeated behavior highlights that the moving average was not simply following the price. It was acting as an important technical level where market participants consistently reacted. The more often a moving average provides support in a strong trend, the more confidence traders may have in using it as a reference point for future trading decisions. The opposite concept applies during a downtrend. In bearish market conditions, the price usually remains below the moving average, confirming that sellers continue to dominate. Whenever the market experiences a temporary rally, the price often climbs back toward the moving average before facing renewed selling pressure. As a result, the indicator acts as dynamic resistance, rejecting the price and creating potential opportunities to enter sell positions in line with the prevailing downtrend. In this particular example, the price tested the moving average as resistance 5 separate times, and each attempt was rejected. This provides a clear illustration of how a moving average can function as dynamic support and resistance, depending on the market trend. Understanding this behavior allows traders to make more informed decisions when planning entries, exits, and risk management. With that, we've reached the end of today's lesson. In the next section, we'll continue building on these concepts with more practical trading techniques. That brings us to the end of today's lesson on how to use the moving average indicator effectively. We hope this guide has given you a clearer understanding of how moving averages work and how they can be incorporated into a structured trading strategy. Remember, becoming a consistently successful trader is a journey that requires continuous learning, patience, and discipline. If you'd like to deepen your knowledge and accelerate your progress, be sure to explore our free trading courses and educational resources through the links provided in the video description. Following our previous lesson on how moving averages can act as dynamic support and resistance, it's time to take that knowledge a step further and apply it in a real trading strategy. In today's video, I'll show you a simple yet highly effective day trading setup that's specifically designed for beginners. You don't need years of experience or advanced technical knowledge to use it successfully. In fact, it's one of those strategies I genuinely wish someone had taught me when I first started trading, because it would have saved me countless mistakes and unnecessary losses. What makes this strategy so appealing is that it takes concepts commonly used by professional traders and simplifies them into a set of clear, repeatable rules that anyone can follow. Never underestimate the power of simplicity. Many traders assume that adding more indicators automatically leads to better results, but in reality, the opposite is often true. After extensively backtesting this setup across multiple market conditions, it consistently produced an impressive win rate of around 65%, which is remarkable considering how easy it is to execute. So let's break it down step by step. The beauty of this strategy is that it relies on just one primary indicator, the 50 period exponential moving average, or simply the 50 EMA. Instead of cluttering your chart with multiple indicators, the 50 EMA allows you to identify the market trend quickly while keeping your analysis clean and focused. The 50 EMA appears as a smooth line that represents the average price over the previous 50 candles, while placing greater emphasis on recent price movements. This makes it more responsive than a simple moving average and especially useful for short-term trading. For this strategy, all you need is a clean price chart with the 50 EMA displayed. Setting everything up only takes a minute. Open your preferred trading asset, click on the Indicators menu, and search for either EMA or Exponential Moving Average. Once you've added the indicator, simply open its settings and change the period length to 50. That's all you need before looking for trading opportunities. The first condition is identifying a market where the price is trading below the 50 EMA. We don't enter immediately. Instead, we patiently wait until buyers regain control and push the price above the EMA. The breakout is only considered valid once a full candle closes above the moving average, confirming that momentum has shifted in favor of the bulls. After the breakout is confirmed, resist the temptation to chase the price. Instead, wait for a healthy pullback. A valid pullback should consist of at least 2 consecutive bearish candles that move back toward the 50 EMA. This temporary retracement often provides a much safer and higher quality entry than buying immediately after the breakout. Once the pullback begins, locate the highest swing point that was formed immediately before the retracement started. Draw a horizontal line across that level because it represents a key resistance area. This line will become the trigger level that determines whether the trade is worth entering. The final confirmation comes when the market reverses and breaks back above the resistance line you've drawn. Be patient and wait for the candle to close above that level instead of entering as soon as the price touches it. Waiting for confirmation helps filter out many false breakouts and significantly improves the quality of your entries. No trading strategy can guarantee a 100% win rate, no matter how good it looks. That's why proper risk management is just as important as finding a good entry. A well-placed stop loss protects your trading capital and ensures that a single losing trade never causes significant damage to your account. To make stop loss placement more objective, we'll use one additional indicator called Chandelier Stop by Pip Charlie. Simply search for it in TradingView's indicator library and add it to your chart. The indicator automatically provides a logical stop-loss level based on recent market volatility, removing much of the guesswork from risk management. For every trade, place your stop-loss at the Chandelier Stop level and set your take-profit target at twice the distance of your risk, giving you a 2-to-1 reward-to-risk ratio. This positive risk-reward profile allows the strategy to remain profitable over the long term, even if not every trade is a winner. Finally, remember that discipline is essential. Just because a setup appears close to meeting the rules doesn't mean you should take it. Stick to your trading plan, wait for full confirmation, and only execute trades that satisfy every condition. To maintain the consistency and overall quality of this strategy, there are two important situations where we intentionally choose not to enter a trade. Remember, successful trading isn't just about finding good setups, it's also about knowing when to stay out of the market. Many beginners believe they need to trade every signal they see, but experienced traders understand that avoiding low-probability setups is just as valuable as taking high-quality ones. The first warning sign appears when the pullback becomes too deep and the price falls back below the 50 EMA. Even if every previous condition appears to be valid, the price breaks above the 50 EMA, closes above it, and then forms the required 2 consecutive bearish pullback candles, we still shouldn't rush into the trade. At this stage, we can identify the previous swing high and draw our horizontal resistance line, but the setup is not yet fully confirmed. Patience is essential because the market still needs to prove that buyers remain in control before we commit any capital. However, if the price falls back below the 50 EMA, before it has a chance to break above your horizontal resistance level, the entire setup should immediately be canceled. This tells us that the breakout has lost momentum and that buyers are no longer maintaining control of the market. In many cases, this type of price action leads to failed breakouts or even a complete trend reversal. Instead of forcing a trade and hoping for the best, it's far more professional to simply ignore the setup and patiently wait for a cleaner opportunity with a higher probability of success. The second warning sign involves the breakout candle itself. While we certainly want to see a strong breakout, an excessively large candle should actually make us more cautious. If the candle that closes above your resistance level is 3 or even 4 times larger than the surrounding candles, it often indicates that the move was driven by emotion, sudden news, or panic buying rather than healthy market participation. These explosive moves frequently become exhausted very quickly and are often followed by sharp pullbacks or complete reversals, trapping traders who enter too late. In summary, not every breakout deserves your attention. Whenever a setup appears unusually aggressive or simply looks too good to be true, it's usually a sign to remain patient rather than chasing the market. Professional traders understand that preserving capital is more important than forcing unnecessary trades. There will always be another opportunity, and by waiting for clean, well-structured setups that fully satisfy your trading rules, you'll improve both your consistency and your long-term profitability. If you're serious about improving your trading skills, make sure to subscribe to the Paradise Trading Tips YouTube channel. Whether you're just starting your trading journey or you've been in the markets for years, our goal is to help you build a stronger foundation with practical, easy-to-follow lessons that actually make sense. On this channel, you'll find everything from beginner-friendly tutorials covering technical analysis, price action, indicators, and risk management to more advanced trading concepts used by experienced traders. Every lesson is explained step by step so you can confidently apply what you learn instead of simply memorizing trading rules. We regularly publish in-depth strategy breakdowns, chart analysis, trading psychology lessons, and practical market examples to help you become a more disciplined and consistent trader. Our focus isn't on chasing quick profits, it's on developing the skills and mindset needed for long-term success in the financial markets. If you enjoy educational trading content and want to continue learning completely free, don't forget to subscribe, turn on notifications, and join the Paradise Trading Tips community. New educational videos are released regularly, ensuring you'll always have valuable content to help you grow as a trader, no matter your current experience level. Now, let's return to the charts. While we previously focused on buying, the 50 EMA strategy is just as effective for finding high-probability sell opportunities when the market turns bearish. For a sell setup, find a chart where price is trading above the 50 EMA. We wait for price to cross and close below the EMA line to start our analysis using the exact same logic. After the price drops below the EMA, look for a pullback consisting of at least 2 back-to-back green candles. Once you see this, draw a horizontal line at the lowest point reached before the pullback. Finally, As soon as the price reverses and a candle closes below your horizontal support line, you enter a sell trade. It is the perfect mirror image of our buying rules. Now that you understand the complete set of rules behind this strategy, it's time to see how everything works in a real market environment. Theory is important, but the true value of any trading system comes from watching it unfold on an actual price chart. For this first example, we'll analyze one of the most actively traded markets in the world, XAU, USD, or gold against the US dollar. On the chart, the blue line represents our 5-0 period exponential moving average, which serves as the core indicator for identifying trend changes and high probability trading opportunities. At the beginning of this setup, gold had been trading below the 50 EMA for an extended period, clearly indicating that sellers were in control of the market. Instead of trying to predict the bottom, we simply waited for objective confirmation. Eventually, buyers stepped in with enough strength to push the price above the 50 EMA, and more importantly, a full candle closed above the indicator. This breakout signaled that bearish momentum was weakening and that a potential bullish trend might be developing, giving us the first condition required by our strategy. Even after the breakout, we avoided chasing the market. Instead, we waited for a healthy retracement to improve our entry. Shortly afterward, gold formed two consecutive bearish candles that pulled back toward the 50 EMA without breaking below it. This was exactly what we wanted to see. At that point, we identified the highest swing high created before the pullback began and drew a horizontal resistance line across that level. This line became our confirmation level, ensuring that we would only enter the trade if buyers could successfully regain momentum. The trade was triggered only after the market proved its strength once again. As buying pressure increased, gold rallied back toward the resistance level and eventually produced a strong bullish candle that closed completely above our horizontal line. This confirmed that buyers had regained control of the market, giving us a valid long entry according to every rule of the strategy. Immediately after entering the position, the stop loss was placed using the chandelier stop indicator, while the take profit target was calculated at twice the size of the risk, maintaining a disciplined 2-to-1 reward to risk ratio. Once the position was open, the trade developed almost exactly as anticipated. Gold continued respecting the 50 EMA as dynamic support, while bullish momentum remained strong throughout the move. Instead of experiencing a deep reversal, the market steadily climbed higher until it eventually reached our predefined take profit target. This example clearly demonstrates why patience and strict rule following are so important. By waiting for every confirmation instead of entering too early, we were able to capture a clean, high-probability trade while keeping our risk carefully controlled. Here's another example. Again on the XAU USD chart, the pair was trading below the 50 EMA for quite a while. We waited for a breakout and then the reversal of that breakout. After identifying the most recent swing high and drawing my horizontal trigger line, the only thing left to do was remain patient. Rather than entering the trade immediately, I waited for the market to provide one final confirmation. Eventually, buyers regained momentum and pushed the price back toward the resistance level. Once a bullish candle successfully closed above the horizontal line, all of the strategy's conditions had been satisfied. That candle close served as my official entry signal, allowing me to confidently open a long position with the trend instead of anticipating the breakout too early. Immediately after entering the trade, risk management became the top priority. I used the chandelier stop indicator to determine a logical stop loss level based on current market volatility instead of relying on guesswork. My take profit target was then placed at twice the size of the potential loss, maintaining a disciplined 2-to-1 reward to risk ratio. As the trade developed, buyers remained firmly in control and the market continued climbing higher. Without any significant pullback, the price eventually reached my predefined profit target, providing another successful example of how this strategy can consistently identify high-quality trading opportunities. So far, we've focused entirely on buying opportunities, but this strategy works just as effectively in bearish markets. To demonstrate that, let's switch to another chart where the market is showing clear signs of weakness. In this example, the currency pair had been trading comfortably above the 50 EMA, reflecting a healthy uptrend. However, market conditions changed quickly as sellers entered with strong momentum. Two large bearish candles drove the price decisively below the 50 EMA, signaling that the previous bullish trend had likely ended and that a potential selling opportunity was beginning to develop. Just like our bullish setup, patience remained essential. Instead of selling immediately after the breakout below the EMA, I waited for the market to perform a healthy pullback. As expected, the price retraced upward toward the moving average and formed 3 consecutive bullish candles. This temporary recovery gave me enough information to identify the most recent swing low before the pullback started. I then drew a horizontal support line at that level, creating a clear trigger point that would confirm whether sellers were truly regaining control of the market. The final confirmation arrived when selling pressure returned and the market broke below the horizontal support level. Once a bearish candle closed beneath that line, every condition of the strategy had been fulfilled, giving me a valid short entry. After opening the position, I once again used the chandelier stop to control risk and maintained the same disciplined 2-to-1 reward-to-risk ratio. Shortly afterward, the downward momentum accelerated exactly as anticipated, allowing the trade to reach its take-profit target smoothly. This bearish example clearly demonstrates that the strategy is flexible enough to identify profitable opportunities in both rising and falling markets, as long as every rule is followed with discipline. Understanding when to avoid a trade is just as crucial as knowing when to enter. Learning to spot an invalidated setup will save you from unnecessary losses in the long run. Take this example. It started perfectly with price trading under the EMA, followed by a clear breakout. A pullback began, so I marked the swing high with my trigger line as usual. However, before price could break above our line to trigger the trade, it fell all the way back below the 50 EMA. This violates our safety rules and cancels the setup. Had we ignored this rule and entered the trade anyway, the market would have moved against us, ultimately resulting in a losing trade and a hit stop loss. If you enjoyed this lesson and found it valuable, don't forget to give this video a thumbs up. Subscribe to the channel and turn on notifications so you never miss our upcoming tutorials on technical analysis, trading strategies, and risk management. We'd also love to hear your thoughts. So leave a comment below telling us what trading topic you'd like us to cover next. Thank you so much for watching, and we truly appreciate your support. Until next time, trade wisely, manage your risk carefully, and we'll see you in the next lesson.